what we're going to be going over here is the cash flow for financing activities, and we're just going to look at a basic overview of what those financing activities would be. Now, cash flow for financing activities really involves the liabilities and stockholders' equity here for the company. So when we're talking about cash flows here, we really have three different activities that we'd be looking at here when we have a cash flow statement. And I've got it laid out in template form here, where I got the balance sheet account shown here, and then I have the income statement account shown over here. So on our balance sheet here, we have these three different cash flow activities. We'd have the investing activities here, and that would be how the company invests its assets. And then we have our financing activities, and that's how they finance these investments that the company makes. And they either invest them through liabilities or through stockholders' equity. And this is what we're going to be looking at, the financing activities, just the basic overview of it. And then thirdly here, on our for our cash flows, we'd have those operating activities, and that's really the net income here for the company, revenues minus expenses, and that would be the income statement. Okay, so let's look at these financing activities here and look at just a basic overview of what we're talking about. So the first thing I want to mention here, we have to determine the change in cash, the cash either provided to the company or used by the company for these financing activities. And then one other thing we want to talk about here before we get into our financing activities, we want to make a distinction here between stocks, common stocks here are what we call contributed capital here by the company. This is where they're going to issue common stock or preferred stock here to the sell it to the shareholders here. Shareholders buy it, and then they would pay cash, a cash transaction to purchase common stock, preferred stock here by the company. So that could include cash transactions. But what I want to make the distinction of here is the difference between the contributed capital here to financing through common stock and preferred stock versus the investments here in common stock or preferred stock or stocks and bonds here by the company. So when we have to make that distinction here. So for example, the company would have made an investment maybe in some available for sale stock or held to maturity stock. And it could be stocks, or it could be bonds as well here, either held to maturity, available sale, whatever. They're going to make some, invest in some long-term assets here. So remember, those stocks and bonds that we're talking about here, sitting here as long-term assets, they're part of the investing activity here by the company. So that doesn't become part of financing. You have to make that distinction here, that they're going to affect changes here in our cash, but it would be listed under the investing activities here by the company. So that's just to make that distinction before we get into talking briefly about our financing activities. So let's look at our financing activities. Well, for our liabilities, we're going to have our current liabilities here versus our long-term liabilities. Now, for current liabilities, the change in cash, that can be a lot of those current liabilities. Those are going to be going over into our expense section here on the income statement. So that's going to flowing into the income statement here. So you really have to look at what the change in cash is. If you're going to set up some payable and when it's paid off here, then you have to look at the change in cash and how it affects cash. So you're going to have a lot of current liabilities sitting out here that you have to look at to determine if how you're using up cash on those current liabilities. So that you have to be looking at, and a lot of that depends on what is being recognized as expenses here in the income statement. So there you're going to have to do a lot of detailed analysis here to determine what the actual change in cash is. And then moving down to our long-term liabilities here, those would be the bonds issued versus any bonds redeemed versus interest payable on the bond. So there, again, we're getting into a lot of calculations here to see if the bonds were issued for cash here, we would have received cash, versus being redeemed or bought back here, then we would have used cash. And then you're going to have all those interest payable calculations here. When is the actual interest paid out, and affecting the change in cash here versus just setting up a payable. So long-term liabilities, again, a lot of calculations, and you're really looking at long-term debt here, and I'm just showing bonds, and you just have to be cognizant here to look at versus they're being issued here versus being redeemed, and when any interest is actually paid on those bonds. Okay, so those would be our liabilities. Now moving over to our contributed capital here, and we touched on that before. That would be our common stock and preferred stock. Now, we're going to issue them for cash versus, the key here is you're going to look at if they're issued for cash versus exchange for assets. So that's the key thing that you have to look at. So if they're issued for cash, then you're going to it's going to be cash provided. It's going to increase your cash account. But a lot of times common stock is exchanged for either buying into another company or buying long-term assets or making investments here. So there's really no cash exchanged at that point. It just becomes an exchange for an asset for the common stock. So that's what you have to be looking at here to determine if there is any change in cash. You have to look at the fact here, if you issue common stock, that doesn't always mean you're going to receive cash here if you make that exchange for some asset. So that's what you have to be looking at. And then also moving down here, this additional paid-in capital account, that would be included with your stock here. So you have to look at those two accounts hand in hand here to see how they're affecting your stock, or how you're affecting the change in cash. And then under this contributed capital, we have to be concerned with moving down here what we call treasury stock. So this is where the company is buying back or buying back some of the stock that they have outstanding. So you have to look at this treasury stock here as a change in cash as well. So the treasury stock is really a contra account to our contributed capital. But there you have to be cognizant here of how that treasury stock is affecting any change in cash. And then finally, moving over here under, again, our financing, we have the earned capital section here. And that would be our retained earnings less our dividends. The dividends, there's a contra account, or it reduces our retained earnings. And really with the retained earnings here, that's our earned capital. That is really the net income or loss that's coming in from the income statement. So generally, there's no change in cash here when you're talking about your retained earnings. It's the change in cash is really being taken care of in the operating section here on your income statement. It's coming in from the income statement. And then when moving down to our dividends here, this is the key where you have to look at the change in cash, the dividends declared versus dividends paid here. So just looking at, for example here, company declares dividends here, it's going to reduce your retained earnings, but by declaring the dividends doesn't necessarily mean the cash is changed. You just set up, you have to move over here under current liabilities and look at that dividends payable. When the dividends are actually paid, then it's going to affect the change in cash. So what we've done here is we just went over a basic overview here of this financing activity to see where it fits into the, in the case here of a cash flow statement. So financing activity sits here on your balance sheet, and that's the liabilities that you take on here to invest in the company here, and then also the stockholders' equity. That's what you're selling stock here to your investors, and there you're trying to generate cash in order to, again, invest in the company here. So that's the financing activities here that basic overview that we're looking at. Okay, so let's move over here and just look at just for a statement of cash flows to see where the financing activities set in here. So first you're going to have your cash flows from those operating activities, and that's really on your income statement. We really didn't look into that here. And then you have your cash flows for your investing activities. That was the company invested in their assets here and long-term assets. Then thirdly here on your cash flow statement, you have your cash flows for your financing activities. And then there you have to determine the net cash change, your cash provided versus cash used. So cash provided would be the cash inflows to the company here, used would be the cash outflows. So you're looking at your net amount here, and in each of these activities you have to list the individual items, and you might put some non-cash flows down. You would be putting that, you have to make the distinction, cash flows versus non-cash flows. The cash provided and used is really the cash flows. And then finally, I've got some numbers thrown out here. You have to determine, again, cash provided or used for each of those activities. You net that amount, and it has to compare with your cash here at the beginning of the period versus the change in cash here at the end of the period. So that's what we're really getting down to when we're looking at this cash flow statement. So we would be, in this case, we were just overview of those financing activities, what we had to be careful of determining the cash flow for those financing activities. But when you come down to it at the end here, you have to look at all your cash flows, financing, investing, and or operating, financing, and investing activities, and that total change in cash flow has to match whatever you had at the cash in your cash account at the beginning of the period here versus your cash account here at the end of the period. So that's what you're looking for, total change in cash here. But we were just going over our financing activities to get an understanding of what they may be included. So total change in cash here for each of those for the activities combined has to match your change in cash here for the period. Okay, so that'll summarize our discussion here on the cash flow for financing activities, and we just had a basic overview. Let's go back and look at our template again here. So again, our cash flow financing activities falls on our balance sheet under the liabilities here that the company assumes, and also the stockholders' equity here, either as contributed capital, or capital at being contributed here to the company, and we have versus the earned capital. That's the retained earnings less our dividends. So that's what we're talking about for financing activities. All right, and to see how it fits into our investing activities versus our operating activities. Okay, so that'll summarize our discussion.